Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
If you notice what has been happening in 2009, well, sort of the reverse of what happened in 2008. Remember, the ICFX options are dollar relative. So whether you're looking at Aussie, Canadian, British pound, euro, I took these screenshots as of this morning, you're seeing the same thing where you're seeing dollar weakness across the board. The one that's a little bit different is this Japanese yen, because we've seen sort of weakness over and over there. But the other five, I won't say that they trade in tandem, but there are themes. You know, we know that the Canadian dollar will trade a lot like the Australian dollar from time to time. The euro might trade a lot like the British pound, and then last year it didn't. The British pound was much weaker. You know, the Swiss franc might trade a lot like the euro, and then for whatever reason it might not. Options give you options. That's essentially it. These options are available through your equity options broker. You can implement your view of the foreign exchange market, again, through using hedging. You can actually trade up to 12 months. There are what are called option cycles. So every 3 months we actually release a 12-month option. Otherwise, the 10-month options are available. Just to summarize what I spent the last 45 minutes on, options create a lot of different alternatives for investors. FX options can be used for limiting losses in a view. Let's say if you have a bullish or bearish view of the dollar. You want to target income with limited losses, you could do credit spreads. You want to create unique payoffs, you could do debit spreads by being willing to actually pay for that spread. You can create volatility positions. So last year, if you didn't really know where the market was going, but you had a feeling that something was going to explode, you could have done that. You could have done volatility trades. Hedging currency exposure, you definitely can do that. Most importantly, investors should learn all the different strategies. Right? I just went through. I mean, this is options. I go through about the different ways to use options. This is it. I mean, you could probably have subcategories, but if you think about options, hopefully you'd find a couple of strategies that are appealing to you. And implement them. You want to understand all of them prior to entering any options transaction. So that's the most important thing. ICFX options allow investors to hedge their currency risk. And you know what? You can do this. You can also do this in, if you weren't looking at foreign currency markets, you want to do this in equity markets. Same thing. You could build a portfolio. You could build a hedge if you'd like. Of course, all of us are wondering why we didn't do this last year. If you did it on mid-March last year and you hedged your portfolio, you probably weren't happy. So you have to decide how much hedging is appropriate for you. And it depends on your ability to take risk. Lots of strike prices, lots of months. You must consider the costs. As I showed you, the costs are greatest for the in-the-money options. They're cheapest for the out-of-the-money options with the most potential risk if your currency moves away from you, and that exposure that you're susceptible to, you're subjected to, starts to come to be. Well, then, the out-of-the-money option is not going to help you until you get to that strike price. You need to think about risk-reward. Really, really important. Want to remind everyone that we offer a lot of things at the ISE. We have trade alerts. We have, those are free trade ideas. We have FX Options Weekly Outlook, Jason Ayers from optionsource.net. Most importantly, at least I think so, the webinars are just fabulous. I've heard so many positive reviews from the attendees. Hopefully I'm bringing in special guests that are very valuable. They teach you something about their area of expertise. I've written articles. The widget there, ISCFX Options widget, you can download that. So many different things that are available. I think that if you continue to come to the webinars, you'll find your comfort zone, and then you want to trade in that comfort zone. You don't want to exceed that because that's trouble just around the corner if you're exceeding your comfort zone. At this point, I want to try to answer all your questions. Andrew has a question about hedging. As I said, I think you can hedge. Andrew's question is, what about hedging the stock market? Isn't that a unique advantage of FX? Actually, no. I think you could do this in the equity markets also, Andrew. Hedging, the only problem with hedging is you have to think about the costs. And some always say, well, why would you hedge in the equity market? Because the option volatilities are always infer a greater amount of volatility than really is exhibited. And then I say, well, what about 2008 when you could have bought, let's say, options on the SPY at maybe a 12, 14, 16, 18 volatility, and the market actually moved to a 50, 60, 70 volatility. So you can do it. As far as the FX market, you can definitely hedge, and especially you're an importer, exporter. Some are going to use futures. Some are going to use the spot, which is rather challenging. But I think options are great because it gives you the ability to tailor it to your own needs, different months, different strike prices, lots of different ways to trade it.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.